All right. So, in light of the COVID situation, we've decided that we're going to try and give classes digitally for the next couple of weeks. There's a plan for the week of March 23rd, that we'll be using a software package called Zoom. But in the interest of avoiding the loss of any time at all, I thought that what I would do is I'd record the March 16th week lecture and use YouTube to distribute it. So that's what this is. This is the lecture that would have happened in a couple of days on Tuesday. So bear with me. The software, this situation is new to all of us, and so we're doing the best that we can. I'm going to present this lecture as if you were in section E, which was a little bit behind D. So for section D, there's a few things that'll look a little repetitive. You guys were a couple of minutes ahead, but you can certainly scroll through those, and within a few minutes, both sections should be largely caught up with each other. All right, so the other thing I'll do is I'll recap what we had covered last class, because this is an important topic. I want to make sure that we're all fresh and on the same page. So the area that we're looking at right now is asset pricing, and we're going to attempt to use the pricing kernel approach to value assets, which we'll use this. This will service us in two ways. One is it gives us another way of sort of thinking about how to decide if we should buy a stock or not, or an investment. The second way it's going to service us is it's going to allow us to integrate the conversation of information pretty nicely. So where both classes were last class is I had shown you in equation 14 here that the price of any security I at any time t could be expressed as the expectation of the cash flows multiplied by the stochastic discount factor, what we call the SDF. And the notation for this is often a little m with a tilde on top, the tilde indicating the random aspect of the discount factor. And so you take the cash flows, multiply those by the discount factors, consider probabilities, the expectation, and so you arrive at a price. And that's what this equation effectively is saying. Now the section in the middle here is just me showing algebraically a decomposition so that we can keep track of things. I mean, in principle, what we're saying is we're going to take the sum of cash flows over time. This is not unusual. This is column 308. Those cash flows, we use the letter X to depict the cash flow here for company I at time t, are in the numerator. And then in the denominator, what we see here is we have a discount rate, 1 plus Ri over t. So I being a specific discount rate to an individual firm. We'll revisit that point and talk about why we would think that in most cases it would actually be systematic and that all firms would possess the same discount rate, but we won't get it there just yet. In the second part of this expression here, what I'm doing is I'm simply breaking, algebraically, I'm simply separating the cash flows from the discount rate piece. Okay, so this is again the SDF in effect. And so what we're talking about doing here is separating what we could think of would be largely, not completely, but largely what we'd call firm-specific considerations. That is the cash flows of the firm. And we would think that generally the SDF is somehow given by the macroeconomy, the broad economy, and so this would be sort of more like the systematic consideration. The other way you could think about it is when we were doing the Ross APT, we were talking about, when we did the Ross APT, we did the expected return on some stock was equal to, let's say, the risk-free rate plus a beta times some premium. Okay, and so the beta was specific to the company I, and then the premium was given by the broad economy. So you could think of this as sort of being macroeconomic or systematic, and this would be sort of firm or asset specific. And so the same idea applies here. It's not the exact same mathematical expression, but the idea is that we can kind of look at this piece as being sort of a common component that all stocks or all investments encounter, and an idiosyncratic or firm-specific piece that only individual firms possess, and that there may be some variation there. All right, so what I did last class was I jumped ahead a little bit to show you how to do some computations. There are a couple of points that I want to get off of the slide before we do that, though. Namely, I would like to comment on this little equation here, which is saying that we can modify the pricing expression by considering information. So this dash t here is basically conditioning on an information set. In the example I give on the next slide, I'll show you an application of that exactly, which will help make this concrete. But this information set is basically what you know as an investor or as a trader, that perhaps other people may share some of your information, but it may not be an exact overlap. So you could imagine this is my information set, Dave's information set, and let's say this is your information set. And so, oops, info set. And so there's some overlap in what information we possess, but then there's unique information. Ideally, when you're trading, what you would really like to have is a situation where your information set completely, what we say, nests the person you're trading against. That is, you're better informed than the trader that you're trading against. And the reason being is because you can then anticipate how they would value something because you possess their information. You could determine what they think something is worth, and then you could determine what you think it's worth. And this is a situation where you're more informed than the trader, and so you should, to the degree that information is profitable, you should extract some benefit from that. And hopefully, what we have in here is the McGill students, and hopefully this is the JMSB students here. Right? This is what we're going for. So, first idea is to conceptualize this, and then we'll talk about what we could put into the information set in the next topic when we discuss signaling and the like. We're not quite there yet. Okay, so I will show an application of this conditioning, but I just wanted to make sure that you guys are comfortable with the notation where the Z here is indicating that there can be some modification to some of the other information. The expectations, the discount rates, the cash flows could be affected by Z, and we'll show an application of that. All right, the other little equation I want to show you is this, which in fact you've been using since probably before 308, but it's just the notation that we have here might make it look a little unfamiliar. All this is saying is that the expected return on something is simply equal to the price that we expect to get in the future minus the price that we pay now over the price that we pay now. Okay, so you've seen this repeatedly. I've used it in my class, and obviously you've seen in many situations. When we were discussing bonds, for example, I had a situation where we assumed that the cash flows were being held constant, and I would make the argument like what was happening last week, where there was a flight to quality, and people are going to Treasury bills, that as bond prices were going up on the U.S. Treasury bill, what the impact would be is, given that these two numbers were increasing, that is, this is a negative and the denominator is increasing, the only way you could make this equation hold constant, assuming the government pays the same fixed amount, which in the case of a Treasury bill it would, the face value is declared in advance, then the impact is that the yield to maturity would be falling. Right? The expected return on those securities falls. And that's what we've seen actually last week, where we saw that U.S. 10-year Treasury notes have fallen below 1% for the first time, and they were bouncing, as low as 0.5% at some point. So I haven't looked at them most recently, but I expect that we'll be looking at another week of turmoil. Why am I taking some time to talk about this expression? The reason I'm talking about it is because I want you just to be able to map to the notation that we're going to use in the asset pricing. It's the same formula as we've always seen, but you'll notice that here we have the price, and that would be given by equation 14 here. So that is the price is equal to EMX, conditional on Z, assuming you have any information set. And the price that you expect to get in the future, you'll notice that it looks very similar, but there is a missing term. There is no M here. Okay, so this is the expected cash flows that you're going to get in the future given the information Z, but you notice that there's no discounting. Why is there no discounting? Because this is the money that you will receive in the future. To the same degree that we did not discount cash flows, speaking of cash flows at time 1, now let's say I received $10 at time 1 and I'm here standing at time 0. It's true that I discount the 10 back to get the price. That's this. But it's not true that I do anything to the 10 here. Having arrived at time 1, if I'm standing at this point in time, then this 10 is just $10. And so the cash flows that we receive at this time would be just simply $10, assuming there was no uncertainty. The E represents the probability there. Okay, and so when you're doing this, just be careful that you don't accidentally put the M in here. I've seen that happen on a few cases where students in final exams have accidentally confused the expected cash flows with the price, and you don't want to make that kind of little error. Okay, all right. So I think that's the conclusion mostly from what I would like to draw on this first slide. I may jump back to it to build up some more intuition, but for the time being, that's all we have on this slide, and we'll proceed to the next.